So we are looking at what we call short-term planning. So under short-term planning, what are we required to know? That is topic number what? Topic number 3, right? What the examiner wants us to know under short-term planning, ladies and gentlemen, and decision making, we must be able to know how to make use of payoffs for purposes of making decisions. Yeah, thanks, John. Yes, for purpose of making decisions. And this payoff at times may not be given. So the examiner will want you to do what you have to create it. So making decisions using maxi, max-mini, minimax regret, getting what we call expected value of perfect what information. Then your examiner wants us to carry out what we call break-even what year analysis. Break-even analysis, CVP. Then your examiner wants us to do what we call limiting factor. This limiting factor, we have to extend it and do what we call the throughput accounting. Then we do the throughput, what there? Throughput accounting. All right, so I can see a problem there. We shall be able to address those problems. For now, let's focus, please. Let's focus here with the advanced MA, because what they are saying is that 1 hour class is colliding with their FRA, advanced FRA. We shall discuss about that later. For now, let's focus. All right. Now, ladies and gentlemen, from there, the other thing that will be very, very important for us to do here, it will be the make or buy decisions, if you remember them, make buy decisions and other things. So we have finished this except for the homework that I gave you. So this homework, would you want me to look at it or would you want me to give you more time to think about it? The online guys, the homework that I gave you yesterday about umbrellas, would you want me to do it or do we look at it? Najma, I can guess 100%. I can guess 100%. You guys have not tried the question. You've tried the question, right? They have tried the question. They have tried the question. They have tried doing the question, and unfortunately, they were not able. They were not able to do it. So then I shall be able to do it, just brushing over it pretty fast. Brushing over it pretty fast. Share the question paper. So remember, this is August 20 what? August 2025. So it is August 2025, the homework question. August 2025. Question number 1, boy. Question number 1, boy. It was a very interesting question, similar to the one that we did yesterday. So we are told here, 𝐬𝐴 Limited is a company that specializes. Have you gotten it? You're looking for it? Okay. Meaning you haven't done your homework, but we shall overcome. No worries, yeah. 𝐬𝐴 Limited is a company that specializes in the production of umbrellas for the year ending 31st December 2026. The company is planning to produce special promotional umbrellas branded Jumbo. 𝐬𝐴 Limited wishes to determine the optimal number of umbrellas that should be produced. Additional information, if all the umbrellas are sold within the year 2026, they will be sold for how much? 900. They would be sold for 900. If we sell them within season, we fetch a better price. If the company is unable to sell all the umbrellas within the year 2026, then they would be sold in the following year at a lower price, which is 300. The production cost per umbrella is 400. The demand for the umbrellas depends on the performance of the economy, which is unpredictable. Number 5, the following are the possible states of the economy. Economy, they are good, average, poor. 𝐬𝐴 Limited has to decide to produce the umbrellas at one of the states of the economy in order to match forecast demand. The opportunity cost of not selling one umbrella, is 100 shillings. They want us to construct a payoff table showing all the possible what year outcomes. So remember, the states of nature are this economy and the demand, isn't it? So we have the states of nature, our states of nature. So our states of nature, basically this will be demand, which of course is pegged on the performance of the economy, which could either be what year somebody? Good, average, and the poor. So if it is good, we shall be able to have what demand? 500,000, isn't it? If it is average, 350,000. If it is poor, 300,000. So we can have this as a demand. Yeah. And then on this side here, we're going to do what? Supply or production, isn't it? Yeah, umbrellas produced. So production, or what we shall call what here somebody? Supply, because demand and supply must match. Demand and supply must match. You see, now many people will not tell you, but you are supposed to know. It is the same demand figures you have, you shall be able to have down. Same. Mlifikiria hivyo, eh? Wanafunzi online mlifikiria kweli hivyo. That you're going to have the same figures here. 500,000, 350,000, 300,000. Lakini sasa, uko nauliza swali. Lakini kitu ya maana zaidi ni ujue tafadhali hapa juu naweka states of nature, the probabilistic. You see, ukiangalia question vizuri, probabilistic events are what ya demand? It is demand column you're able to see there. Probabilistic event. That's what unaona kama hii good. Good umesema probability ni ngapi? 0.3. Hapa probability ni ngapi? 0.46. Probability ni ngapi hapa? 0.24, like that. Ukiweka probabilities, probabilistic events hapa utanyoroshwa na CASNEB. Na CASNEB, wacha tuone. Asante sana. So unakuja namna hii, unaweka namna hii, unaweka namna hii, namna hiyo. So this is cell number 1, cell number 2, cell number 3, 4, 5, 6, 7, 8, 9. Yeah. So tuanze, you see, payoffs are profits. How much profit shall we realize in each of those cells? In each of those cells, yes. So cell number 1 is interesting because cell number 1, the supply is how many? 500,000. And demand is how many? Interesting. So how many shall we sell? All of them. Hii bodi yangu inakaa mbaya. Ngoja. Hii bodi yangu ikai poa. Niandike hapa chini. So for cell 1, so we have supply 500,000. Then we have demand. Wow, this is very good. A very good coincidence because I supplied 500 and I got 500,000 members consuming. Very interesting. So we sell 500,000, isn't it? So if we sell 500,000, then you see here there is nothing that is perishing. We're going to sell everything within the year. So each umbrella will fetch a good price. So it will be 500,000. The good price is what here, somebody? 900. Minus the cost of production. 500,000 times what here, somebody? 400. Ile contribution margin 900 minus. Hiyo hatuwezi tumia sana hapa vizuri kwa sababu you see the prices are changing. You see kuna time price 900, another time price in 300. So that price na fluctuate, you'll still get the same answer. You're going to struggle more when you use that CM. We use CM approach when the selling price is ever constant in all the set. You see, like the question we did, the price never changed. Here the price is going to change. When the price changes and you don't have any match option, use this. Uh-huh. Uh-huh. Yeah, itakusumbua kidogo, tufanye tuone, utatusema ni gani kwa better, ni gani kwa better. So in this particular case, ladies and gentlemen, look at this. Cell number one, the supply is how many umbrellas? 500,000. And the demand is how many umbrellas? 500,000. So you see, you compare supply and demand. And effectively, we sell the lower. Here, there is no lower. Here, they are identical, isn't it? So you shall sell 500,000. And then if you look at that question very well, because we are selling all the umbrellas, so this cell number one, we are selling all the umbrellas within this season. Zimeisha. Nitauza 900. Na mimi cost of producing each one of them is how much here, somebody? Is 400,000. So I want you to do me a favor. Please do your bracadabra calculations, and whatever answer you get, you divide by 1,000,000. I want all my figures to be in millions. I want my figures to be in shillings millions. Whatever answer you get there, divide by 1,000,000. So mnasema ya kwanza kabla ni 250. 250. Aya. 250. So then let's argue out cell number two. Cell number two. So cell number two, what is happening, my friends? Aya, wacha tuone sasa. So katika cell number two, I'm seeing my supply is 500,000. This cell number two here, my supply 500,000. My demand from up is how much? 350. Demand is 350. So what does this mean, ladies and gentlemen? This is very interesting. So we shall sell how many normally? We sell the lower. So this lower, so we shall sell 350,000 at what price? At 900. Si ni kweli? Lakini sasa inamaanisha mimi nilikuwa nisha produce umbrella mengi. So nimebaki na zingine. So nimebaki nazo, what do I do with them? I sell them next year with a lower price. So in this case here, we will sell, what is the difference? At what price? 300. And our cost of production? But how many umbrellas are we producing at 400? All of them. Because you see, production, we produced 500. Of which out of the 500, we sell 350 today at 900, and then the 150 perishing with it. So then the cost will be 500,000 times 400. So then are you able to do your abracadabra? So you say 350,000 times 900 plus 150,000 times 300 minus 500,000 times 400. Tell me, what are we getting there? There is an opportunity. Cost. Very. Not selling, eh? Very good. Let's read this. Let's read this. I love the questions that you guys have. You're inquisitive, and many questions will always make sure that all of us will learn, including myself. I learn every time from my students. Like there is a time, I used to do this thing like this. I used to do and this I learned from high school people. So I used to tell people that 2/3 plus 4/5. Now, Guruma nawaambia weke LCM. LCM ni ngapi? LCM hapa ni 15, isn't it? Now uliza 3 inaingia mara ngapi hapa? Times 2, 10. 5 inaingia mara ngapi hapa? Times 4, which gives me an improper fraction of 22 over what? Sasa mwanafunzi mmoja akarealize andiki, akaniambia sasa mwalimu, ni method gani? Akaniambia, what if I did it this way? 2 times 5, 10. Plus 3 times 4, 12. Over 3 times 5. Are we going to get the same answer? Yeah. And since then, now I've been using their method. Yeah. Their method. So we learn. We also learn from students often. Great. So then let's try reading this question again, because I think, that's me, I think you haven't yet understood this question. I think you haven't yet understood this question. Let's read it. Perhaps I may not have also understood it. It happens. Look at note number 7. The opportunity cost of not selling an umbrella that is demanded is what here, somebody? Is 100. How does that work according to your understanding? Mm-mm. Mm-hmm. Mm-hmm. When demand exceeds what we are supplying. So for example, we supply 500,000 umbrellas and the people down there want 600,000. When demand is higher, a customer comes like what Nakumat used to tell us. Remember when Nakumat was Nakumat? They used to tell us if you need it, yes. If you go there today, nothing, isn't it? So you can only, in this case here, charge that as an opportunity cost if a customer comes and misses something. In this case here, is there a customer who is missing? How can they miss and yet you are perishing with some goods? Are we together? Because you see, if for example, you're doing it this way, let me tell you a secret. We have your supply. Yeah. For example, supply is 300,000 and then demand is what here, somebody? Maybe 500,000, isn't it? So in this case here, we sell how many? The lower, isn't it? So we sell 300. What we have, isn't it? Are you saying demand is more now? So now this is where you will disappoint customers. We only disappoint customers when demand is higher than supply. Write that where somewhere there in mother tongue, in your mother tongue. Yeah, that the concept of disappointing customers only happens whenever demand is greater than supply. Opportunity cost can only apply. Opportunity cost can only apply whenever demand exceeds what here? Supply. So let's repeat this, right? Number 2. Let's repeat number 2. Let's repeat number 2. Let's repeat number 2 so you can be on the same page. I can see Juguna saying, please repeat. Yeah. Let's repeat number 2. Let's repeat number 2 for us to be on the very same page, because this thing comes like it never came last semester in terms of construction of a payoff table. If I'm an examiner, then automatically I'll be able to test students whether they know how to construct a payoff table. There is one question, and I hope I will remember, the one of cement production. Cement, very good question. I'll send the question into your groups today. A very good question. And that one, the moment you do it, then this concept of payoff table shall never defeat you at all. So let's repeat cell number 2. So cell number 2, we are seeing 2 things happening. I can see a supply of how many bags? Umbrellas, I mean, 500,000. So I'll come and draw supply, 500,000. So for cell number 2, what are you able to see as demand? For cell number 2, demand is 350, isn't it? So in this case here, am I going to disappoint any customer? I see all the demanded umbrellas I'll supply. Demand is lower than. Actually, I'm the one to be disappointed, isn't it? Yeah. So then in this case here, we sell what here, somebody? Yeah, Wongo. At 900. We sell 350,000, the lower, isn't it? We sell 350,000 at the normal price, which is 900. And then, of course, we have a balance which we are not able to sell this year. What have they told us? We sell at 300. And that balance is how many? To make it 500, isn't it? So sell 150 at 300. And then cost of production. Cost of production will always be pegged on supply. So supply 500,000 times what here, somebody? So then to get profit, it's revenue minus cost. Revenue, 350,000 times 900 plus 150,000 times 300 minus the cost there. Whatever answer you get, you divide by 1,000,000 because our figures are in shillings millions. Thank you, Cheryl. They're giving me a figure of 100 what year? They're giving me a figure of 160. They're giving me a figure of 160. Is that okay? Now that you have become the superstars, is it I show speed? Give me number 3, the profit for number 3. Give me the profit for number 3. Just imagine it's all about, Mercy, have you divided by 1 million and show you're dividing by 1 million, eh? Whatever answer you get, you divide by 1 million because our payoff is in shillings millions. Number 3. Kama ile mbegu ya kanyari, 310. Kama ile mbegu ya kanyari. Are you sure the 310 number is 130? Try again. Try again. Melvin Musavi, Robert Langata, they are getting 130. Ni 130 umetranspose. Hapana, Lucy amepata 310 na maanisha 310 iko na maneno. Asanteni sana kwa kujaribu. Kupotea njia ndio kujua njia. Frank, Mr. Frank anasema 130. Lucy, thank you so much. Umekoma na 160. Njuguna amesema 130. Cheryl 130. Munyoki Mavuti 130. So now that I've given you a chance to try it, can I do the question myself? Can I do the question myself? And then we see Quinta. Quinta did a very, very good post. Quinta did a very, very good post on LinkedIn. Vile amepita intermediate level, which was really, really very good. That's the very best way of giving yourself visibility. And then, of course, start branding yourself on LinkedIn that I've passed this level and now I can do financial reporting. There's a way you do it. Financial reporting. Your profile will really be on demand. One day, it will really pay. And then, of course, you tag RCM. Like Quinta. Quinta, if I had the money today, would have given you something. 130 is correct, isn't it? 130 is correct. So do you want me to do it or that is it? We got 130? Wanasema mwalimu usifanya hiyo. Correct answer hapa ni 130. Is there anybody who wants mwalimu to do it? Anybody online who wants mwalimu to do it? Abracadabra. Ivaya. I have a problem identifying the state of nature. Okay, Joseph, I'll be able to address that. Anne Moturi, do it. Pokor Z, do it. We shall overcome. No worries. No worries. Let me do it. Let me do it. Let me do it. So number 3. Number 3. What is happening in number 3? Are you able to see the supply? Are you able to see the demand? Are you able to see for number 3 here, the supply will come all the way from here. So supply is how many? 500,000. And then demand is how many here for number 3? 300,000. So you normally, you will sell the lower at the normal price. You sell the lower at the normal price. So the lower one is which one here, somebody? So we sell 300,000 times what here, somebody? 900. So I sold, you remember I supplied 500. I've been blessed to sell past 300,000 at a good price, which is 900,000. What about the balance? We disposed them at a lower price. And the balance is 200,000 because our total supply is 500, isn't it? So 200,000 times what here, somebody? 300. And then, of course, the cost to us, the cost of the total supply is 500,000 times what here, somebody? 400. So remember, our profit is total revenue minus total cost. Total revenue minus total cost. So total revenue is the sales. 300,000 times 900 plus 200,000 times 300 minus 500,000 times 400. Give me an answer. Winnie Shihuli gives me a figure of what here? 130. So now all of us, are we in agreement with this 130? Yeah. Now let's get to where the rubber meets the road. Grrring. Number 4. Let's see. What answer do you have for number 4? Cell number 4. If you get cell number 4 correct, 6. There is a gentleman telling me that cell number 4 is 160. No worries. No worries. No worries. No worries. No worries. Great. Great. No worries. Great. 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 Life is good. Life is good. Life is good. Here, opportunity cost. Thank you so much, Knight. Knight is reminding everybody that here, opportunity cost will come in play. I love that. Rina Mwanyika, very aggressive person, saying that number 4 is 100 and what here? 60. One? No, no. 160. You must have forgotten to subtract the opportunity cost for the umbrellas that people came to ask and the gotire. Ukiambia mtu gotire anaenda kununua kwingine. Una lose goodwill. You lose goodwill. You lose goodwill. You lose goodwill. Felista ya amesema ni 100. Now that I've given you a very good chance of trying it, can I do it myself? Can I do it myself? So number 4, give me the supply, give me the demand. So supply is how many? We are supplying 350. And then the demand is what here, somebody? 500. So here I can see myself disappointing. I will disappoint how many customers? 500,000 minus 350. Those will be disappointed. Because I have fewer umbrellas. Watu wakienda wakinyeshewa lakini watasema kampuni yangu brand name. Yeah. So in this case it's 150,000, isn't it? This will be disappointed. But how many umbrellas are we selling? The lower, isn't it? This and this. So you're selling 350,000 at what price? At 900, isn't it? We are not going to perish with any umbrellas as we took the market 350,000. Unfortunately, we sell all of them. So then we look at the costing bit of it, isn't it? So the costing bit of it, the first cost, which we have there, is production cost. Production is always pegged on the supply. So the production is 350,000 times 400, isn't it? But again, we have another cost in the name of what here? Opportunity cost. For the customers that you disappoint, you disappointed. How many customers do we disappoint ourselves? And for every customer we disappoint, our company loses how much? Our company loses 100. So now there we have, Ivaya is saying 180. So remember the sales is 350,000 times 900, isn't it? Minus the first cost, 350 times 400, minus the opportunity cost, which is 150,000 times 100. So what answer shall we get in number 4? 160. Lucy is saying 190. I don't know why. I don't know why. Perhaps in this case here, there are batteries. I have a problem now in the calculator because already now we have everything here. Sales revenue, 350,000 times 900, minus 350,000 times 400, minus 150,000 times 100. Nancy getting 160,000. So now you guys should be able to give me answer for number 5, 6, all of them. Mine will now be to sit down and get figures from you. Like now, Pius is giving me cell 5, 175. And then you will realize the more you do with these things, they will become so easy. You can even do now without this analysis. Yeah, Pauline, thank you so much. Cell 6 from this gentleman, 145. Cell 6, 145. Cell 6, 145. So now I'm waiting for cell number 7. Cell number 7. Now we are waiting for cell number 7. 30. 130. Cell 7, 130. Umesikia wengine hapo wamenyamaza kabisa. Cell 8 is 145, eh? Hata 8, wanasema 38, hata 8 at 145. 8145. I have cell 9. Cell 9 is 150. Thank you very much for having attempted the question. Because of that great gesture, you can see now you are able to understand this question pretty well. So somebody was saying that they still have a problem identifying states of what? States of nature are probabilistic events. Yeah, probabilistic events. If you give me this kind of a table, note number 5, I will be able to, the following are the possible states of the economy. These ones here, good, average, poor. With probabilities, and of course, you can see number of umbrellas demanded. So all this will go to the states of nature area. So you can see the state of the economy. You can see the demanded umbrellas, the probabilities like that. And then because we have here the demand, you see demand should be equal to supply. So I have to match these numbers downwards. I must match those numbers downwards. So yes. Very good. So suppose, for example, these are losses. So maybe you have -5, you have say -10. And then you are asked in this case here, best of the best. So the best of the best in that case here will be a smaller loss. -5 here. Best of the best, smaller loss. A smaller loss. So now before I proceed, is there any profit that you guys have a problem with here, which you would want Mwalimu to do it physically here? Before I proceed. Please feel free with me. You shall always feel free with your father. You shall always tell your father most of these things. Never fear your father. Your father, you shall always be very free with your father. You would rather, in this case here, hide a few things from your mother, but not your father. Watu wanasikia sisi tukiongea sauti kubwa, wanatuogopa ati baba ni wakali. Hapana. We are the best. So Martin wants me to repeat number 5, eh? Martin, do you want me to do number 5? Yes, okay. I'll do it straight away. Thank you. So let me do number 5. Let me do number 5. So cell number 5, I'll draw something like this. But as you progress, you'll realize you don't even need these things. So katika cell number 5 is here. You see the demand, or rather the supply here, is 350,000. Supply is 350,000. And then for cell number 5, demand is what here? 350,000. Actually, this is very good. Why? Because it's a perfect match. So in that case here, we sell everything. 350,000 at what price? 900. It's perfect match. No disappointing customers, no perishing with anything. So I will sell 350,000 at 900, which cost me 350,000 at what here, somebody? At 400. Cost does not change, eh? Cost is always the same. Cost is always the same. And Martin, that will be the answer. So you simply take here, you see profit is revenue. Profit is revenue minus what here? Minus cost. So it is 350,000 times 900 is my revenue. The cost is 350,000 times 400. Yeah. So first of all, with Martin, are we together that 175 is correct? Martin, are we together that this is correct? 175? It's too hot, eh? Yeah, we've been told in this case here to see what we can do here. Yeah, in 2-3 months' time, this will be a very beautiful place. Very beautiful place. Yeah. Aha. So Martin hajanipatia feedback. Martin ameniuliza swali, mimi nimejibu, lakini hajanipatia feedback kama tena nirudie zaidi ama sasa imekuwa sawa. Martin, nijenge stadium. Thank you very much, Pius. Thank you very much. It's okay now. Thank you very much. Then somebody is asking me to explain cell number 8. Let me explain cell number 8. Cell number 8. So cell number 8, not a problem. I should be able to know what I'm supplying for cell number 8. I'm supplying 300,000. I'm supplying 300,000. And then the demand for cell number 8. This cell number 8 demand is 350,000. So in this case, what is really going to happen here? We are disappointing some customers. So we are disappointing. We are disappointing. How many customers are you going to disappoint here? Why are we disappointing? We are disappointing customers because demand is more than the supply. Demand is more than the supply. Yeah. So now a small profit statement. So then we shall be able to sell how many? So in this case, we sell the smaller, isn't it? So we sell 300,000 at what price? Normal price of 900, isn't it? Then now we have two costs. Which costs are these? We have the production cost, which will be pegged on what we supply. Production cost is always based on what you supply. So 300,000 times what here, somebody? Times 400, isn't it? And then we have opportunity cost of disappointing customers. Opportunity cost of disappointing customers. And we're disappointing 50,000 customers. And for every customer you disappoint, how much? 100. For every customer you disappoint, it's 100 bob. So then give us our profit. It will be 300,000 times 900 minus the two costs, minus 300,000 times 400, minus 50,000 times 100. What are we able to get at the end of the day? What are we able to get at the end of the day? Are we able to get that 145? Oh, yeah, Oh, ni uongo. Adonija James has confirmed 145. PCF is getting 100. Ebu PCF chukua calculator yako vizuri. Useme 300,000 times 900. Useme not plus but minus. Minus 300,000 times 400. Minus 50,000 times 100,000. It shall give us PCF, just confirm. It shall give us 145. It shall give us 145. Sasa iko sawa. So which criteria do they want us to use to advise? Maxi or maximini? Zote kabisa? Aya. Advise the management of US Limited on the optimal level of production based on expected value, maxi, and maximini criteria. The only problem with that question, of course, that is a very easy question, but what do you think will happen if one of your numbers here or two numbers are wrong? You get 0 in the entire question here. If some numbers are wrong. So now number 2, 0. There's no but because cast labor people mark very fast. They don't be able to look at the methodology. So you get 0. So we start with expected monetary value. Ann Moturi is getting 100. Where do you think is the problem here? Nipe calculator. Why are they getting 100? It's 100, eh? This cell number 8. Let's see. 300,000 times 900, isn't it? Minus 300,000 times what here, somebody? 400 minus 50,000 times 100. I'm getting 145. How comes they're getting 100? And there are very many students, eh? When you put 500, upper. Oh, when you put 500,000. Oh, but you see now, please don't do that because even him, he got 100. Don't do that. You see, supply, we are supplying 300,000. How many customers are coming to demand? 350. So how many customers shall we disappoint? 50. So please, this 50,000 times the disappointment fee of 100. PCF. Disappointment fees of 100. So when I get my profit, I'm taking, in this case, here, sales revenue of 300,000 times 900 minus the first cost, 300,000 times 400 minus the opportunity cost of 50,000 times 100. Got it now. Thank you so much. You've saved a situation. You've saved a situation. So now I believe all the other cells are okay now. With that noise having been made, I believe all cells are okay now. So now we can easily go and get expected monetary value. So give me expected monetary value, which is X times P. So we have here first supply. So supply 500,000. 500,000 supply. So I can see here 250 times who? 0.3, isn't it? Plus 160 times 0.46 plus 130 times 0.24, which then ended up giving you guys what figure? Nafaa kuandika hapa. Sorry, nafaa niseme hapa plus 130 times 0.24. Njeru D is getting 190 at cell number 6. 190 at cell. Is it cell 6 or cell 9? Did I see it wrongly? This gentleman is getting at cell 6. Cell 6 is getting 190. Cell 6. Okay. So now this is the time for Maghrib prayers. Yeah. It's always good to observe time always. If you want to succeed in this world, you should always observe time. So then when I come from the Maghrib prayers, which will be at exactly 7, we shall be able to answer this great ninja who never misses any of my classes, Njeru. He's very, very serious. I shall be able to do for him and prove that 145 is correct. Is correct. Cell 6 here. What is the supply? Supply is 350,000. For cell 6, the supply is 350,000. How about the demand? 300,000. So first of all, that representation, is it correct, these online ninjas? That for cell number 6, supply is 350,000, demand is 300,000? Yes. Then in this particular case, what is going to happen? The moment you understand what will happen here, I can see a situation where I'm going to perish with some things. Because I've supplied more, wateja ni wachache. So in this case here, the excess, here I can talk of excess. How many do I have as the excess? 50,000. So then we make now our sales report. So sell how many? The smaller one, isn't it? 300,000 at the normal price. These are the customers who will be able to buy normally at 900. And then now this excess, which I'll be perishing with, still God is gracious because I have a market for it. In most questions, you'll be told that you perish and nothing will happen, 0. But now here, I'm going to sell them next year at a lower price. The lower price is what here, somebody? 300, isn't it? 300. 300. I don't know why you are seeing this to be very, very technical. Yeah. And then, of course, we look at the cost. The cost will be the cost of all the units here supplied. And how many are they? 350,000 times what here, somebody? Times 400. I don't see this to be a very difficult thing, really. So that 350 at 400,000. So that now the sales will be 300,000 times 900 plus 50,000 times 300 minus the entire cost of production. So are we in agreement that this number 6 here will be 145? It will be 145. The question only gives the demand. Where do you get the supply figures from? Very good questions. You see, whenever you're given demand, remember the concept of supply demand in economics. That supply should be equal to what your demand? Whatever demand figures you have here, you take them down exactly the same. So Joanne says sell 7, 300,000 times 900, 200,000 times 300. Let's do cell number 7. It's like they want me to do all the cells, eh? I see that is the second. They want me to do all the cells. We shall overcome. We shall overcome. So cell number 7, supply, demand. So supply for cell number 7, supply is how many? 300,000. And then demand is how many? 500,000. So in this case here is a situation of demand outstripping supply. So it's a question of disappointment. I'm going to disappoint how many customers that will come to my shop and they'll not be able to get the umbrellas? 200,000. 200. So I disappoint 200,000. So then let's do a profit report. So profit report, how many am I going to sell normally? The lower, isn't it? So we sell 300. At what price? At 900, isn't it? At 900, 300,000 at 900. All right. And then in this case here, we go to the cost. So cost, we start with the cost of supplies. The cost of supplying how many units here, somebody? 300,000, isn't it? What is the cost of supplying each umbrella? It's 400, isn't it? Yeah. Do we have any other costs? Yes. The disappointment fee. Opportunity cost. So opportunity cost. So opportunity cost in this case here will be these disappointed people. And for every person you're disappointing, how much are we going to lose? 100. So Joanne, you can see you are really offside, isn't it? You're offside. Offside. So it will be 300,000 times 900 plus 300,000 times 400 plus 200,000 times what here, somebody? 100. Shall that be able to give us what we have here? Number 7 as 130. Shall that give us 130? I think so, isn't it? Yeah. So could you then kindly give me the expected monetary values now? Please, if there is any you haven't gotten, just understand that we are right. You go and now try to put in some effort to get all the others. So come here and create a column for expected monetary value. We start with the first one. Expected monetary value for the first one will be 250 times 0.3 plus 160 times 0.46 plus 130 times 0.24. Which gives me 179.8. From there, we have expected monetary value for 350,000. So I take the profits, multiplying them with their probabilities. So 160 times 0.3 plus 175 times 0.46 plus 145 times 0.24, which will end up giving us what figure? 163.3. From there, we come to this other option here. 130 times 0.3 plus 145 times 0.46 plus 150 times 0.24. 141.7. So which one is the very highest? Yeah, so this is the best EMV. So then the EMV, best decision, supply how many umbrellas? 500,000. Supply 500,000 units of umbrellas. Umbrellas. EMV, best decision. Because for expected monetary value, the higher the money, the better. The higher the better. The higher the better. So expected monetary value, best decision will be to supply 500,000. From there, they also want us to help them make a maxi what here decision? Maxi. What do we say about maxi? This is the best of who? Best. And we normally start with this. So create a column where you capture the best payoff for each alternative. The highest. So like now the very best here is which one here? 250 is the best. You go to the second alternative and pick the best, which is what here, somebody? 175. The very last one, which one is the very best? 150. And then amongst the very best, pick now the highest amongst all of them. 250. Maxi, I'm being told, maxi, this is the best of the best. Best of best, yes. That's the best of the best. So the best maxi decision. Yeah, again, supply how many umbrellas? Yeah, so maxi decision supply 500,000 umbrellas because they correspond to this 250. That is maxi decision. Yeah, somebody called Clinton Odhiambo is raising his hand. Would you want to say something, Clinton? Yeah, I can see you have put down your hand again. All right, never be ashamed. I can always unmute you anytime. Anytime, feel free to ask questions. So then we have maximini. Maximini, maximum minimum is called best of who? Best of worst. And we always start with the second part where you come and give us the worst decisions, worst payoffs. You don't have to rub yours. Yeah. So give us here the very worst. So you start with the worst for each. So which one is the lowest? The 250, 160, 130. 130 is the worst. The second alternative, which one is the worst? 145. Which one is the worst here? 130. So then remember, we want to pick the best of the worst. So among us the three, which one is the best of the worst? 145, isn't it? So 145 is the best of the worst. 145 is the best of the worst. 145 is the best of the worst. So then the max-mini decision, yeah, supply how many umbrellas? Yeah. Supply 350,000 umbrellas. Supply 350,000 umbrellas. Thank you so much. So I would want you to go and watch that video if possible one more time. Watch that video if possible one more time. Otherwise, please allow me to go straight away to what we call break-even analysis. Allow me to go straight away to what we call break-even analysis. Break-even analysis. Break like this, not the one of a vehicle. Break-even analysis. So are you able to remember break-even analysis from your intermediate level? So you did intermediate level the other day, last semester. We shall overcome. Oh. Oh. Even FM, yes. Even FM, yes. Even FM, yes. So tell us there that break-even analysis is a cost, volume profit. Is a cost volume profit. CVP is a cost volume profit technique. Yeah, technique used to determine the level of activity. Used to determine the level of activity the level of activity used to determine the level of activity at which total revenue, at which total revenue, at which total revenue, at which total revenue equals total cost, equals total cost, equals total cost, equals total cost, resulting in zero profit, resulting in zero profit or loss, like that. So anytime we talk about break-even point is the point where profit equals zero. That point where revenue equals what here, somebody? Cost. So let me know once you guys are able to finish writing this. Once you finish doing that write-up, especially the online students, I know at times you struggle with the internet. Let me know by, yeah, they're finished. Thank you so much. So we can mention there pretty fast that at break-even point, revenue equals who? Cost. And therefore, profit will be pi. Whenever you see pi here, pi is not 22/7. Pi is profit. And therefore, profit equals who? Zero. Profit equals zero. Now, ladies and gentlemen, if you remember very well, there is a very fundamental equation that I'm aware you guys may have forgotten. That normally profit is CMX minus who? That's how we get total profit. This is the break-even analysis profit equation. To get profit, we shall be taking CMX minus who? Like that. So this pi is the profit. CM is the contribution margin. CM is the contribution margin. Is there anybody who is able to remind us how we normally get CM? Selling price minus variable cost. To get contribution margin, we normally take price minus variable cost, like that. So price per unit minus variable cost here. If it's for 1 unit, you see contribution margin is per unit. Ruth, thank you. But if it's per unit, we shall always take the selling price minus variable cost. What is this X? X is quantity, sales quantity. Sales quantity. And then we have F, which is what here, somebody? Fixed cost. F is fixed cost, like that. F is fixed cost. F is fixed cost. So this equation, I would always want us to remember it. Yeah. And we are saying here that our profit equals CMX minus who? And we are saying that at break-even point, what is the value of profit? Zero. At break-even point, profit equals zero. At break-even point, profit equals zero. So please make X the subject of the formula, knowing that profit is zero. Make X the subject. Make X the subject. So make X the subject. So if you try making X the subject, our pi will be zero. Equals CMX minus who? Fixed cost. So I want you to make X the subject of the formula. Make X the subject of the formula. If you make X the subject of the formula, ladies and gentlemen, it means automatically this comes this side. So it will be minus CMX equals minus what here, somebody? So minus and minus does what here? Cancels. Meaning that our X will be equal to F over what here, somebody? Over CM. X will be F over CM. And that X then will be the quantity to sell to break even. So in conclusion, ladies and gentlemen, our quantity to sell to break even, our X break even equals fixed cost over what here, somebody? Contribution margin. So you will be given an illustration. So this illustration, my friends, you'll be told fixed cost of the firm. Fixed cost is $1 million. Fixed cost is $1 million. And then we have, ladies and gentlemen, price, which is 10. Variable cost is 6. You are required to determine BEP. Determine a break-even point. Determine break-even point. Thank you so much, Ruth. Determine break-even point. Determine break-even point. Determine break-even point. So nikishasikia break-even, I know it is fixed cost over CM. I know it is fixed cost over CM. Nikishasikia to break-even point, I know it is fixed cost over CM. So my X break-even will be fixed cost over CM. So then give me the value of CM, abracadabra. Give me the value of CM, abracadabra. CM is 4. Because you see CM is selling price minus variable cost. The selling price has been given here. It is Kenya shillings 10. Variable cost is how much? 6. So that gives us 4. So try to substitute there. We see fixed cost over CM. Yeah. So the fixed cost, ladies and gentlemen, here is 1 million. Fixed cost is 1 million over CM of what? 4 there, which gives us 250,000. Which gives us 250,000. Now, please listen, and I would want you to listen to me very, very carefully. You see there, automatically, what that means is that we have what we call a single product, and then we have what we call multiple what? Yeah, multiple products. So single product, to get X to break even, you will take F over what here, somebody? But if they are multiple, to get X break even, you will take F over WACM, weighted average contribution margin. So you can just write this pretty fast, that this WACM stands for weighted average contribution margin. Weighted average contribution margin. Weighted average contribution margin. Weighted average contribution margin. Then I would want us to do the last question for tonight, which is April 2022. Question number 1D. April 2022. April 2022. Question number 1D. April 2022. Question number. Yeah, X break even. This is the quantity you have to sell to break even. Quantity, and I explained what X stands for. B is break even. Quantity to sell to break even. You can write somewhere there. Quantity to sell to break even. Kapata question ama bado rakaraka nifanya just some small concept itakuwa enough dose. BB Limited. Mary Ann has gotten it. BB Limited. BB Limited. BB Limited. Meipata BB Limited. At least online wameshapata mbio mbio. BB Limited. BB Limited. BB Limited. BB Limited. BB Limited. So BB Limited. BB Limited. BB Limited. April 2022. Question number 1, dog. Question number 1, dog. So we are told there BB Limited sells 2 types of products branded what and what here? D and A. The financial controller has prepared the following information based on sales forecast for the period. So we have DA. Great. The common fixed cost relate to the cost of common facilities and can only be avoided if neither of the product is sold. The managing director is concerned that the sales may be less than forecast and has requested information relating to break-even point for the period. So they want us to give them the break-even point of the two products in units and the sales value if they are sold in original sales mix. So how many products do we have here? 2. So it's a multiple product case. And if it's a multiple product case, then the first thing you need to do is to come and give us X what here? X break even. Give us X break even. The formula will be F divided by what here, somebody? Yeah. So could you kindly give me the total fixed cost in this company? Give me the total fixed cost in the company. See, anybody who is able to see the fixed costs? 39,000, right? You see, we have, we have direct avoidable fixed costs. Are you able to see 117,000? We have two types of fixed costs there. We have to be very, very careful. So 117,000 plus the common ones. Because you want total fixed cost for the firm, whether avoidable or nothing, you simply give us the total fixed cost. So we have the avoidable of 117,000, and then we have the common indirect fixed cost of how much? 39,000. This is how students get it wrong. So I'm being given a figure of 351, Linda, I don't know. Check again. Should be 156,000, isn't it? 156,000. Thank you so much. And then now from there, you see we are doing Roman 1, where we are using the current sales what here? The current sales mix. Current sales mix. Current sales mix. So I want us to get WACM. How do we get WACM? It's very easy. You take the weight of the first product, contribution margin of the first product, plus weight of the second product, contribution margin of the second product. So remember these W's, these are weights, yes. And they are normally obtained from the sales what? Sales mix units. They are normally obtained from the sales mix units. So we have two products. We have D and then we have A. Are you able to see their sales mix? Wait, they are not talking to me. Sales mix. Are you able to see their sales mix units? Units. The very original one, I can see there 1,200 and what here somebody? 600. Giving me what total? 1,800. Therefore the weights. So the weight of D will be 1,200 over 1,800. No, ukiround off itapatia shida. Ili wachana ikuwe wata fraction hivyo. Hii itakuwa 600 over what here somebody. So up to there, the online guys, are we really together? Sitaki tuandike 0.67. Hiyo decimals zinataka shida sana. Hizo decimals hizo huleta shida sana. Haya, asante sana. Asante sana. So then, we have the contribution margins. Fortunately, in this question, this examiner was gracious enough to give us the unit contribution. Are you able to see the unit contributions in the question? 150 and 90. Yeah, if you wish, of course, you can say this 2/3, or you simply cancel the zeros, no problem. So then I want you now, good students of mine, to give me this WACM now that you have everything there. Now we have everything. So come here and give us the WACM. The weighted average contribution, what here? Margin. Give us the weighted average contribution margin. So you take the first weight, 12/18, times contribution margin of the first product, 150. 150. Plus, ladies and gentlemen, the second product's weight, tumesema ni 6/what here, somebody? 18. You can still cancel them, times 90. So is there somebody who is able to give me this weighted average contribution margin? Mary Ann is giving me a figure of 130. Mary Ann is giving me a figure of 130. 130. Are we able to get 130, all of us? If you use that 0.67 whatever, you would have gotten 129. You will still be okay, but you will miss out on a few things. So that is WACM. Therefore, I should be able to come and get the X break even. X break even. So X break even is fixed cost over WACM. And the fixed cost, you guys had given me a figure of 156,000 divided by 130. 156,000 divided by 130. Which ones? Zitacancel tu zenyewe. Hata ukiweka pa 1200 over 18 zitacancel zenyewe. Yeah, zitacancel zenyewe. Ile answer itabaki ikiwa 130. So they are giving me an answer of 1200. So you see, we have answered the first question where they wanted us to give them the number of units that we will sell to be able to break even. But you see, now they want us to convert this as well to money. Revenue break even. Yeah. So they also want us to convert this to revenue break even. So how do we convert this to revenue break even? There are so many methods. So many methods. First method, we know that this is a compound figure. We have units of D and units of what here, somebody? Split that up. Split. Split the above. So we have here D. We have A. So D, remember, we shall use this criteria, the proportions. So 12/18 times 1200. A is 6/18 times what here, somebody? 1200. So are we able to get this? 800 what here, somebody? 800 and 400. Woyo wameanza kunyamaza, wameanza kuchoka. Sales revenue, yes. Sales revenue. So we start by splitting the above. So now we have the quantities, isn't it? Are you able to see the prices of these products? Do you know their prices? They're given on the table, selling prices. 300 and what here, somebody? 300 and 200. 300 and 200. So is there somebody who is able to remember the formula for getting revenue? How do we get revenue? Selling price times quantity. So revenue equals price times quantity sold. In short, you simply multiply these two. In short, you multiply those two. 800 times 300. So Harriet gives me 240,000. Harriet gives me 240,000. And then we have A, 400 times 200. 240. No. No. 8,000. 80. 80,000. 80,000. Meaning that this will be 320,000. So this is the revenue. The revenue break even. The revenue break even is 320,000. The revenue break even is 320,000. Revenue break even is 320,000. Revenue break even is 320,000. But you see, there are so many methods you could use. So many methods you can use to be able to arrive at the same answer. For example, we can come and say here that revenue equals, of course, in this case here, selling price times what here, somebody. But you see now the prices that we have in these, there are two. It means that this price, because of the multiple products, should be weighted average price. How do we get this weighted average price? Very easy. I will take weight 1 times price 1 plus weight 2 times price 2. So do we have the weights? The same weights. The same weights. So weight 1 will be 12 over what here? 18. Do we have price for the first product? Price over how much? Price was 300 plus weight 2, which is 6 over 18, times price 2, which is what here? 200. So is there somebody who can give me a very beautiful answer out of this? Weighted average price. Weighted average price. 12 over 18 times 300 plus 6 over 18 times 200. Please give me this weighted average price. Give me a weighted average price. Inakuja ngapi? Wamekataa kuongea. Decimal ni sawa, nikija decimal ni sawa, nipatie. 266.666. Hiyo figa kwa nini kwa calculator mimi nataka hiyo figa sana. Hiyo figa mimi naipenda sana hiyo. Hiyo figa kwa calculator iko sawa. Alafu tunasema kwamba revenue break even. Revenue break even. Revenue break even will be equal to the weighted average price times XBE. So the weighted average price is 266.66667. And what is the quantity to break even? Are you able to multiply and then you confirm whether you're getting that 340,000? It will give us exactly 340,000. Whatever figure you have there, it will give us that 340,000. Correct? 3 or 320,000. It will give us that 320,000. Thank you so much. Bye-bye. See you tomorrow for advanced financial management. Although 1:1, so weight itakuwa 0.5. Because you see, ni kama kusema sales quantity. So we have D and A. So 1 unit, 1 unit. So giving us what there? 2. So then weights will be 1 over 2, 1 over 0.5. I hope I've answered your question. Yeah. So everything in the back is the same. All right. The weights are very, very key. The weights are very, very key. Yeah. So game ya Arsenal imefanya class ikaisha mapema. We shall overcome, Gathoni, don't worry. The very best user, please call this lady called McKenna. She'll be able to give you all the information regarding whatever class you want to get from us. Whatever class you want to get from us, yeah, call this number 0793 555 000. Mimi nikupata kwa drasa. Otherwise, I'll be taking too much. Thank you. I can see we have Man U supporters.